Yeah, hello. Today we are going to discuss about derivatives in greater depth with future and options. We call it L1 derivatives, future and option. And still, it will be a basic course, and we'll see how we proceed. So, I am instructor here, and I'm Prabhat Kumar, and I represent Investors Delight. So you will see here the future and options in little greater depth, and you will learn future contract in details. Then you will see payoff example in a future contract, in a contango and backwardation market, options as an introduction, various features of options, and then leverage in future and options. So we are coming to the very point to what is the definitions, the very definition of future. We can say a futures contract is an agreement between two parties in which one party, the buyer, agrees to buy from the another party, the seller, an underlying asset or derivative at a future date at a price agreed on today. So today only we decide the price of future, and that's why it is called future, and we have to pay something for that, and that is why it is kind of agreement. This is kind of uh, tradable things, and the various characteristics of the futures that comes is like its standardization, its quality and quantity of goods that can be delivered, uniformity that promotes market liquidity. So all these are the very important characteristics of futures. Further, clearinghouse, each exchange has a clearinghouse. So clearinghouse, it guarantees that trader will honor their obligations, act as buyer to every seller and seller to every buyer. So clearinghouse has to got to play a very important role. So let's take a example of future contract example. You need to buy a crude oil 1 month from now, and the current price of crude oil is $100 per barrel. Now you have three options to fulfill your requirement. The first one is now buy it now at $100 barrel and use it after 1 month. Another next option is you buy it from now at market price prevailing 1 month from now. So this is unknown price, you don't know. And then the third option is enter into an agreement with the vendor so as to purchase the crude oil at a month from now, and that will be nothing but $100 per barrel. So you can have three options. So first option we know is anything you can do, second option anything you can do, but third option is something which is kind of uh, future agreement. So this future agreement is going to give you different results under different circumstances. For example, suppose after 1 month the price of crude oil changes from 100 barrel to $50 barrel, or it remains just 100 barrel, $100 per barrel, or it has moved up to $150 per barrel. So it can go to any of these three ranges, and we will see what will be our profit and loss in this scenario. So future contract shows that if a strike price is $100 and spot price is $50, so in case of $50 you are making a loss of $50 per barrel, and in case your spot price is 100 and there is no change, you are making your spot price changes to $150 after 1 month from now, then you will be making $50 profit, and that profit is because you have locked the price today. And the same thing you can see in the graph, it is like the two parallel lines you can see. So depending upon your spot price, like a spot price you can see from 50 to 100 and so on, it can change anywhere. So depending upon spot price, the profitability is very much dependent on that. So if a spot price is 50, profitability is coming as minus 50. If a spot price is 100, profitability is coming as 0. If a spot price is coming as $100, then profitability is coming as $50. So that's the thing that you can see here. And then we have payoff from buyer's perspective. we have payoff from seller's perspective. So it is like you can see if buyer is getting profit, seller is getting loss. So this is not 150 here, but it is 1050. So just this is for example purpose. So don't correlate with the crude oil prices, but just I'm saying that if any case our buyer is making a profit, then seller is making a loss. And if seller is making a profit, our buyer is making a loss. And if this kind of scenario is there, then we call that this whole market is nothing but a zero sum game. So let us see now the example of futures contracts. Some old examples we are coming with Nifty futures as on 29th May 2007, and we see the number of contracts traded on 21st May 2007, 28th June 2007, and then 26th July 2007. These were the expiry dates. So on those dates, how many contracts were traded, and last traded price are something, then open interest is something, we see the value of underlying is something. So all these things are there. So one contract has a lot size of 60 units at that point of time, and hence 1 point change in the underlying results in the change of 60 into one contract. So that's why this calculation holds there. And coming to the convergence of future and spot prices, we will see here that initially the prices will be different, future prices will be higher and the spot prices will be lower, but as the time progresses, the two prices converge, and they converge at a particular point, that is called the zone of convergence. Further to this convergence, we have two kind of markets. One is contango market, one is backwardation market. So contango in the market condition is one wherein the prices of the forward and future contract is trading above expected spot price at the contract maturity. So you can see in contango, future is trading at higher price, spot is trading at lower price, and over a period of time the points goes and converges. Yeah, and then we have backwardation. So in the backwardation is the market condition where the price of a forward or future contract is trading below the expected spot price at the contract maturity. Here spot price is higher and future price is lower. That's why it is called backwardation. And over a period of time, future price goes up and spot price goes down and they converges. So that's the market that you have to understand. And with this, we are going to learn some basics of options. In options, we will see that there is a call option. A call option is an option to buy a certain asset by a certain date for a certain price. So you can see here that we buy all this, but the profit and the profit payout that is there with the buy of call option or the sale of call option is something you can see here. So by giving a small premium, that means you get in loss, but after a certain point of time when market price of the security increases beyond its strike price, you start there is a steady increase in income or increase in profit, and that profit keeps increasing indefinitely. So this is the potential of call option. It can give you unlimited profit potentials with little risk premium that you see here, because the risk premium is something which is a parallel line to this x-axis, and that is the risk premium. And once you break even, you go beyond break even, you have unlimited profit potential. So this is the benefit of call option. Put option is just the reverse of this. So here you the writer of the call option is the actually seller of the call option, and the premium they are receiver of the premium, so they receives premium. So you can see the two profitability curve of both buyer and the seller are exactly, we can say, is a zero sum game, where if buyer is losing, then seller is gaining. If seller is gaining, then buyer is losing. So this continues, and this is a zero sum game you can see here. Similarly, in case of put option, we have uh, very high potential in when the stock prices degrades. So as the stock prices goes down, you can see here the profitability increases, and as it keeps increasing stock prices, then we are at the mercy of whatever is the premium paid, so we lose whatever we have premium paid. So this is used to protect our already, if you are having some assets, so in order to protect its downside risk, we take put premium as a protected put, and other strategies we'll discuss later in details. And you can also see the buyer of the put and the seller of the put, they are having the very mirror image kind of graph, and because of this you can see that they are just like they are just like as you said, playing a zero sum game. So whenever put buyers gains, the put sellers loses, and whenever put buyer loses, the put seller gains. So this is exactly a zero sum game again. Again, coming to the option terminology, we have many things to know. The price of contract is known as the strike price or the exercise price. Similarly, the date in which the contract is going to expire is called expiration date or the maturity. And then we have intrinsic value, which is nothing but the strike price minus stock price. And then we have time value or extrinsic value, which is nothing but premium minus intrinsic value. So that way you should know what is the intrinsic value of the option, what is the time value or extrinsic value of the option. You can calculate all this by using this formula. Strike price minus stock price is going to give intrinsic value. Premium or the call price or put price minus intrinsic value is going to give the extrinsic value. And the premium paid per contract is also called as the price of the option. So premium is the price of the option. So when we say call option of some value or put option of some value, then that is the amount of premium paid to those call and put options. So this is very basic option terminology that you should be knowing. And then we have option pricing also. So option pricing is often done by various kind of factors, like we know a strike price, we know the price underlying of the underlying assets, like if it is a stock like Reliance stock or crude oil or anything that is the underlying asset, we know the price of those assets, so that is important. Then we know the volatility of the underlying assets, means how much it is varying in price every minutes, every second, every hour. All this volatility is important. Then time left for expiry, so if we have a contract, what is the expiry date, that is important. Then risk free rate prevailing in the market. So all these factors when combined together and put on some formula, that leads to option pricing, that is done by Black-Scholes formula, and the prices of options are based on the following. So that's we know. Now we know that exercising options, based on the methods of exercising the options, they are divided into following types. Either they are American options, or they are European options, or they are Asian options. So American options are those which can be exercised anytime before the expiry date. They are American. If they are exercised uh, only on the expiry date, then they are European options. And Asian options have some privilege that they can be exercised on some specific dates, and that's why they are called Asian options. We have to know more about all these things, like why is the difference between options and forward future contracts. So forward futures are some ways similar, but options are different because of the buy sell strategy involved in the options and the future and forward. There this is non-linear payout. Option is a non-linear payout, whereas forward futures are linear payout. Obligation to buy or sell is different in future and different in option. Premium paid in options are different cases altogether. In futures we don't give premium, but we use lots of leverage. So all these things are there, and we'll also see option as an example. Suppose we have an investor purchases one Nifty mat one 1600 call at premium 145. then one contract consists of 50 index shares and the contract is cash settled. If at the end of the option life Nifty value is more than 1000 16,000, he exercises the option and receives amount by which Nifty exceeds 16,000 for one index share times the 50 rupees 50, because 50 is the 50 is contract size is 50. So now suppose the final day value of Nifty is 16,100. So we take the difference of 16,100 into 16,000. So 100 is the price difference, and that we multiply with 50 and we get 50,000 for the contract, 5,000 for the contract. And now if the final day it's below 16,000, he will not exercise the options. For this privilege he pays rupees 2,250, say 45 rupees a share for 50 shares. So that is how option works in real time. So that's how we learned all these things in detail, but still we are yet to go into further details and we'll cover in more sections later. Thank you.